Welcome, friends, in this series of debt funds. So far, we have discussed about debt funds, liquid debt funds, overnight debt funds, and ultra short term debt funds. Today, we will discuss about low duration debt funds and money market debt funds. And after that, we will see short term debt fund and medium term debt funds. Before dissecting these terms, let us first understand relationship between interest rate and bond yield, how it inversely affects the yield of bond and price of the bond are inversely proportional. If the price of the bond increases, the yield of the bond decreases and vice versa. That means if the price of the bond decreases, the yield of the bond will increase. Second thing is interest rate of the bond and bond price are also inversely proportional. If the interest rates increases, the bond prices reduces and vice versa. That means if the interest rate decreases, the bond prices will increase. So this thing we should keep in mind how the interest rate changes affects the yield of the bond and price of the bond. If a mutual fund company or a debt fund company deals in secondary bond, then how it will affect and possible change in interest by RBI, how it will affect the yield of the bond and ultimately associated these debt markets or debt funds. Another sensitive term in this regard is modified duration. Yesterday we have discussed about Macaulay duration of bond. Now, today we will see modified duration. It is the sensitivity of the bond's price. The modified duration, usually this is measured in years. The modified duration of a bond is essentially the sensitivity of the bond's price to the change in the interest rate. If interest rate changes by 1%, then how sensitive the bond price will be. Suppose modified duration is 3.2 years. That means 1% change in interest rate lowers the bond price by 3.2%. Or suppose if it is 1.5% increase, then decrease will be 4.8%. Or if it is a 2% increase in interest rate, then bond price will fall by 6.4%. Suppose if it is 5 years, modified duration is 5 years, then 1% in increase in interest rate will lower 5% of bond price or vice versa. If it is decreases by 1%, the interest rate, then bond price should increase by 5%. So this is the sensitivity to the modified duration. Now we have understand these jargons. Macaulay duration of bond, then relationship between interest rate, yield, and bond price, and modified duration. Now let us see low duration fund, and then we will see money market fund. The low duration fund is similar to ultra short term, ultra short duration fund. Both are similar, but only difference is here. In case of low duration fund, the Macaulay duration is 3 to 6 months. But in the case of low duration fund, the Macaulay duration of the associated or aggregate portfolio will be 6 months to 12 months. So this duration, Macaulay duration, will change here. And the fund is mandated to invest money market as well as bond also. But only criteria is the aggregate portfolio Macaulay duration should be between 6 to 12 months. Let us see some example, real example. This is the IDFC low duration fund. Here we can see this government backed security 17.16 and low risk 77.66%. This category average this one. So they have invested. And if you are deep diving debt holding in portfolio, we can see this government of India, this bond, CD, NCD, bonds, all this highly rated fund they have invested all over this public sector bank. Okay. So this is a sovereign risk. All we can see we are going, they have invested in all low risk fund only, debt funds only, or bonds only. But despite this, there is some associated risk, and we should be aware of this, how much it's modified duration. If its modified duration it increases, then definitely this NAV for the associated bond price will be affected. It will decrease. So we should keep in mind this associated risk, this rating risk, credit rating risk, and default rating risk. Let us see another, this Nippon India Low Duration Fund. Here you can see the government bank and back and low risk, this much. And here also the CD, NCD bonds, CD, all this highly rated funds they have invested all over. So it is wonderful thing, but there is associated risk. We should be aware of that. Of course, this will increase, this yield will increase in comparison to ultra shorter fund. Here, little bit extra we can expect return. And we can see here modified duration is given 0.79. So if it is less than 1, it is good. Now, let us see money market fund. So this low duration fund and money market fund is similar except one thing. In the case of low duration fund, it can invest both in bond and money market instruments like commercial paper, CP, CD, certificate of deposits, or treasury bills. And even bonds, maybe up to 2 years bond, they can invest. Only keeping in mind Macaulay duration should be between 6 to 12 months. But in the case of money market fund, they can invest only in money market instrument. They cannot invest in bond. So here we can see the risk is more. If somebody have more risk appetite, they can go with this money market fund. And we can see this government back 14.87 and low risk this. But here you will see, you will not see any bond. Money market, only CD, the certificate of deposits, treasury bills, all treasury bills, the CP commercial papers, CP, CD, treasury bills, all this only this fund has invested. They cannot invest in bond. So we should be aware of this fact if you are investing in money market fund and modified duration is quite low. So we should be aware of this. Now another example, CUTI, you can see this money market fund. Here also we can see all CDCP, only CDCP, all over CDCP, government of aware, this government of aware, this treasury bill. So only there they can invest. They cannot beyond go that and cannot invest in bond. Now, the short duration fund and medium duration fund. In the case of short duration fund, this aggregate macro duration will be between 1 year to 3 years. And investors should have their investment horizon more than 3 years. Only then they should invest in short duration fund. And of course, they can expect more return, up to 7% they can expect a return. And in the case of medium duration fund, of course, it will be beyond 3 years. This maturity period will be beyond 3 years. So Macaulay duration of associated bonds, Macaulay duration will be here more than 3 years. So of course, this person should have their horizon far more than 3 years, maybe 5 years or 7 years. Only then they should invest in medium term debt funds. So as per risk appetite, they can expect return and horizon, investment horizon in debt funds. They should invest in these funds. So now, up to now, we have understood liquid fund, overnight fund, ultra short term, low duration, money market fund, short term fund, and medium term fund. Based on investment horizon and risk appetite, one should invest in these funds. Tomorrow we will see some more debt funds and simplify those jargons. Up to now is 4 today and before 3. Total 7 funds we have seen out of 16. Balance 9 we will see in coming videos. If you find some value, please like and share with your colleagues and friends so that they can also get benefit out of this. And please subscribe to this channel if not subscribed so far. Thank you.